This week, Warren Buffett made interesting and inflammatory comments about tariffs. Take a listen.
In 2024, Warren Buffett made a bold move that surprised many investors. Instead of buying more stocks, he sold a massive $143 billion worth of shares. This huge sale left him with over $300 billion in cash. But why did he do this? Buffett believed the market was becoming too risky. With global uncertainties like tariffs, inflation, and political tensions, he wanted to be ready for any sudden changes. Holding so much cash gave him flexibility to act fast when good opportunities appeared. Buffett's strategy shows a deep understanding of patience and timing. Instead of chasing quick profits, he prepared for tough times ahead.
I mean, tariffs are actually, we've had a lot of experience with them. They're an act of war.
This move protected him from losses when the market dropped sharply. By selling stocks and building a large cash reserve, Buffett positioned himself to buy valuable assets at lower prices in the future. This approach reflects his long-term vision and cautious investment style. In this video, I will share how I copied Buffett's $300 billion strategy for 30 days and what happened when I tried it myself. The market crashed. Buffett didn't. When global markets started to fall sharply, many investors faced heavy losses. Stocks dropped, panic spread, and fortunes disappeared almost overnight. But Warren Buffett's strategy of holding over $300 billion in cash paid off big time. While others suffered, Buffett stayed protected. His cash reserves meant he didn't have to sell assets at low prices or take big risks. In fact, his net worth actually increased by about $11.5 billion during this market turmoil. This shows the power of having liquidity when the market crashes. Buffett was ready to buy bargains, while others were forced to sell. His patience and cautious approach helped him avoid the worst of the losses. For many investors, watching their portfolios shrink is painful. But Buffett's move to hold cash proved that sometimes not acting is the best action. Waiting calmly while others panic can save your money and even grow it. In my 30-day test of copying Buffett's strategy, I saw firsthand how staying liquid during market drops can protect your investments and create opportunities.
A Berkshire Hathaway, it'll get given away gradually.
Next, I'll explain exactly what I did to follow Buffett's steps. Emulating Buffett's strategy to understand Warren Buffett's $300 billion cash strategy, I decided to try it myself for 30 days. My goal was simple: reduce my stock investments and hold more cash, just like Buffett did. At the start, I sold a portion of my stocks, focusing on those that were volatile or overvalued. I kept only a smaller, safer core of investments while converting the rest into cash. This gave me flexibility to react quickly if the market changed. Every day, I monitored the market closely. I watched news about the economy, inflation, and global events. Just like Buffett watches the big picture, my plan was to stay calm and ready, not panic or chase fast gains. Holding cash felt strange at first because I'm used to investing everything. But I realized that cash isn't just idle money, it's a powerful tool to buy when prices drop. During this month, I didn't make big new investments, but stayed alert for bargains. It was a test of patience and discipline to hold cash instead of rushing to buy or sell. In the next part, I'll share how I managed my daily routine while copying Buffett's cautious approach.
And that's something you shouldn't count on. We make all our acquisition decisions ourselves. I mean, we don't call in consultants or anybody.
Monitoring and adjusting. Every day during my 30-day experiment, I followed a strict routine to manage my investments like Warren Buffett. I started by checking the overall market trends and important news, focusing on economic reports, interest rate changes, and geopolitical events. These factors influence the market and help decide when to act. Next, I reviewed my portfolio to make sure my cash reserves stayed high, just like Buffett's massive $300 billion cash pile. If I saw any signs of unnecessary risk in certain stocks, I adjusted by selling a bit more to maintain liquidity. I avoided panic selling or buying based on emotions. Instead, I reminded myself that Buffett's strategy is about patience and long-term thinking, not quick moves. Staying calm during market swings was key. I also looked for potential buying opportunities, but resisted rushing. Having cash ready meant I could move fast if a good deal appeared. By the end of each day, I tracked my portfolio's balance between stocks and cash, making small tweaks as needed to stay aligned with Buffett's cautious style. This daily discipline helped me understand the power of watching, waiting, and being ready, the core of Buffett's investing approach. Next, I'll share the results I saw after these 30 days. Gains, losses, and insights. After 30 days of copying Warren Buffett's $300 billion cash strategy, I carefully reviewed my portfolio's performance. Holding a large cash reserve gave me safety during market ups and downs, just like Buffett experienced. My investments didn't grow as quickly as in a fully invested portfolio, but I avoided big losses when the market dipped.
He said, well, you can keep track of your portfolio. And I said, I only have one stock. I said, I mean...
This showed me the value of liquidity. It's like having a shield against sudden crashes. At the same time, I missed out on some quick gains because I wasn't fully invested in stocks. But Buffett's approach isn't about chasing fast profits. It's about protecting your money and waiting for the right moments to buy. This experiment taught me that patience is crucial. Holding cash may feel slow, but it provides options and peace of mind when markets are uncertain. Overall, copying Buffett's strategy helped me understand how a big cash position can balance risk and opportunity. It's a conservative but smart way to invest, especially in volatile times. Next, I'll share the lessons I learned about discipline and patience during this experiment. Patience and discipline. Copying Warren Buffett's $300 billion cash strategy taught me some important lessons about investing, especially the value of patience and discipline. Holding a large amount of cash felt uncomfortable at first because I'm used to keeping money fully invested to chase quick returns. But Buffett's strategy showed me that sometimes waiting calmly is the best move. Patience means not rushing to buy stocks when the market looks tempting or selling when fear strikes. Buffett's huge cash reserve gave him the power to stay calm during market drops and act only when the timing was right. I learned that controlling emotions is key to long-term success. Discipline was equally important. I had to stick to my plan of holding cash and avoid impulsive decisions based on daily market noise. This discipline helped me avoid panic selling or chasing risky investments. In the end, the experiment showed me that investing isn't just about making money fast. It's about protecting your capital, staying ready for opportunities, and being patient enough to wait for the right time to act. Buffett's approach requires confidence and a long-term mindset, qualities every investor should develop. Is Buffett's strategy right for you? After trying Warren Buffett's $300 billion cash strategy for 30 days, it's time to decide if this approach fits your investing style. Buffett's move to hold massive cash reserves helped him avoid big losses during market crashes and gave him the flexibility to buy assets at lower prices. This shows the power of patience and preparedness. However, this strategy isn't for everyone. If you want quick gains and are comfortable with market ups and downs, fully investing in stocks might suit you better. But if you prefer to protect your money, reduce risk, and have cash ready for opportunities, Buffett's cautious approach can be very smart. The key is understanding your own risk tolerance and goals. Buffett invests with a long-term view and the discipline to wait for the right moment. If you can adopt that mindset, holding cash as a safety net may improve your investment results. In the end, copying Buffett taught me that sometimes doing less and waiting more can be the most profitable move. Think carefully before choosing your path. Success comes from strategy, patience, and knowing when to act. If you want more real investment experiments and strategies, Don't forget to hit that subscribe button and join our community. What do you think? Is holding massive cash the smartest move, or is it better to stay fully invested? Share your thoughts in the comments below. Your opinion might help others rethink their approach.